Hello, everybody. So thank you so much for joining us on our first webinar of the year. This is something I think we're going to start doing quarterly, where we're going to review the last quarter and just see what happened in the market the past quarter. And at this time, it's a perfect time to review what happened last year. And we'll talk, a little bit about what's happened thus far this year. So as an advisor, we find it's our job to help you, the client, understand your portfolio. And by knowing what happened, you'll ultimately be able to decipher your results and hopefully be comfortable with where those results fell. So let's get into first what happened last year. So looking at the market summary of the last 1 year, 5 year, and 10 years, we see that the United States stock market has really outperformed the rest of the world when it comes to the stock market performance, global equity performance. Last year up 25.66%, international developed markets up 12.62%. Emerging was down, and you see the leader was global real estate, which was up over 31%. Now, I can tell you that's what did happen last year, right? What's happened so far this year is really almost the exact opposite of what had happened last year. We'll talk a little bit more about that as we move forward. But as you can see, like the United States, which is where you have most of your money, if you're working with Baer Wealth, has been a leader over the past decade. That's not always true though, but it has been. It certainly was last year as well. Here's looking at the headlines, and the point of this slide right here is to show you that you don't invest because of the headlines, because there's always going to be a reason not to invest, whether it's you don't like who's the president, you don't like what happened with Congress, you don't like a bill that was passed, you don't, the price of oil going up is highlighted here, inflation, a million reasons to invest, and every year reasons not to invest, and every year it's going to look the same. Never are you going to look at everything and say, oh my goodness, this is, everything is fantastic. Unfortunately, that's just not how the world works. But the silver lining is none of this stuff really has much influence on future expected returns, right? So if oftentimes we get questions about, should I invest at a market high? And the answer is, well, it's not, mathematically speaking, objectively speaking, it does not influence the future expected return. The return of the market 12 months after a market high, as is illustrated, it hit here at some point during 2021, is not lower than at other times. So the answer is markets are priced for you to make money always. Does that happen every day? Of course not, as we've seen the first month of this year. It certainly hasn't happened. But they're priced to make you money. That's why anyone would ever invest in them, right? You're taking the risk to hopefully receive that reward. Here's a look at what happened in the fourth quarter, right? So the last 3 months of the year in 2021. And we see just the different, returns of the different parts of the market, right? If I'm looking at the fourth quarter, large growth is what did the best. Does that mean it's going to do the best going forward? Not necessarily. It did the best. If you look at what actually in the United States, which part of the United States stock market did the best, small value last year was up 28.27%, which led the way. Another fascinating part too is if you look in the bottom left-hand corner of your screen, this is the entire circle, right? The entire pie chart represents the entirety of the world stock markets. And the United States by itself makes up 60% of the world stock markets. A lot of people find that very surprising, but it's still, there's 40% left, right? Should we avoid investing in those 40%? And the answer is no, you shouldn't. Now, last year you might have been better off had you, but we don't know that going forward. So if we look at the returns last year of international developed markets, right? And what that means, it means companies that are headquartered in places like Great Britain, Japan, Canada, countries that economic systems are stable and closer to that of the United States, makes up 29% of the rest of the world. So we have the US making up 60%, and we have international developed markets making up 29%. We can look at the returns of those markets over the past year, past quarter, as reflected here. If we move to the bottom left, we see emerging markets, which are countries like Israel, China, Brazil, countries that still are relatively stable governments. We're not talking about some third world countries. Those are actually called frontier markets, and they make up less than 1% of the total world market. But emerging markets make up 11% of the world stock market, and they had the worst year in 2021. That being said, they're actually priced for the highest expected returns, but they had the worst performance in 2021. What ultimately had the best performance was REITs. So US REITs, if you look at, returned 46.91% in 2021. They returned 17.22% over the in the fourth quarter of 2021. Phenomenal returns. We probably saw a lot of this. I can tell you, my home, I'm sure your home appreciated in value over the course of 2021. And then if you see in the bottom left-hand portion, the real estate investment trust is what REITs stand for. And you see that 67% of real estate investment trusts are in the United States, and the remaining 33% are throughout the rest of the world. And so it was a great time to be invested in real estate and REITs. As we know, that was great last year. So far this year, it's actually kind of softened up more so than even the market, but yet to be seen. I know most all of us really have a portion of real estate in our portfolios, either directly through REITs, which we have in some accounts, or directly through the homes that you own or real estate property, what have you. Below are the returns of countries in the fourth quarter of 2021. As you can see, the Egyptian market had the highest return. The Turkish market had the worst return. What that tells you about next quarter, unfortunately, is nothing, because to be honest, don't know exactly what has happened in the Egyptian market so far this year, but oftentimes these flip, and there's no way to say buying the country with the best market the last quarter means it's going to have the best market this next quarter. Is it doesn't work that way. If it did, it all would be a lot easier. But where you see is that when you combine all of the different assets from different countries, your return is highlighted there in blue. That is the global market's performance between all the asset classes over the fourth quarter. And then if you look at the United States, I believe the United States was in the seventh position there, as you can see, and we're going to send this out afterwards as well. Moving on to commodities. Commodities had a very good performance overall, but one probably surprising fact of the commodity performance in the year 2021 was the poor performance of gold. Even though it did well in the fourth quarter, as you see highlighted at 3.95% for the fourth quarter, for the year, it actually had a negative return. That's how most people are accessing the commodities markets. I don't know many people that are trading in coffee futures or corn futures or cattle. But if you had, you possibly could have made money. But it's they're very volatile and very speculative. And just look at the price of what happened with natural gas. Now, unfortunately, not the price we realize as the consumer, but what happened to natural gas in the fourth quarter, declining almost 40% in value. So that's what we like to really is the risk on assets, the commodities, stocks, the parts that are going to have more volatility, more up and down. And now we move to the fixed income. So this is bonds, right? This is where I'm loaning my money, and in the example shown here, to the United States government, and the United States government is going to give me an interest payment back. They're going to pay me a coupon. And as we all are probably aware, that interest payment is extremely low right now. So if I am looking at the, that chart, right, that says US Treasury yield curve, and what that means is the coupon that you are paid for the period of time you're loaning the money to the United States is, if I loan my money to the United States for 10 years, as of the end of 2021, I'm getting really about a 1%, a little over 1% return on my money. I'm getting paid back 1%. If I am loaning it for 30 years, I'm getting close to 2%. Who's going to loan their money to the United States government for 30 years to get a 2% return on that money, especially when we've seen what we've seen in inflation? And we see the bond market as represented by most common representation of the entire bond market, at least in the United States, is the Bloomberg US Aggregate Bond Index. And that actually had a negative return for last year. But the up and down of that return is much less volatile than the up and down of the stock market's returns and commodity returns as well. The bond market, just like the stock market, is not just centrally located in the United States. If we look at some of the yield, the return you're given for loaning countries like Germany your money, it's even less, right? So you're getting a negative yield if you're a German citizen and you're loaning money to the German government. They would probably look at that as, I'm paying a fee to have somebody hold my money, because otherwise, what is my money? I have no choice, right? I really don't have anywhere else to put it. And so you see negative yields in German markets, in Japanese markets, almost negative, virtually zero. Let's move forward and talk about the impacts of diversification, right? So as you see, last year is a great example. If you were invested in 100% stock market, you were rewarded substantially, upwards of 23.54% return for yourself, for your money. A great return, right? If your money is earning 23% a year, your money is doubling in probably about 4.5, 5 years time. I think anybody would be happy with that. And you can see how it's starting in 1985, $1 invested in a 100% stock portfolio has grown upwards of $58,000 as of the end of last year, as to where $1 in a 100% bond portfolio would be worth $6,371. Obviously substantially less money. So the question to think about yourself is, right, it's obviously great. Everybody wants to be invested in 100% stock when the market goes up. It's just, are you going to be okay when that market goes down? And there's a couple of examples I want the listener, to really think about, in your mind, and think about your own wealth and think, well, is this doing what I think it should be doing, right? So if you are a portfolio of 80% stocks and 20% bonds, and the market loses 20% of its value, you would lose roughly $160,000 from your portfolio. Your money would go from $1 million to $840,000 in an 80% stock and 20% bond portfolio. If you are in a 100% stock portfolio, you would have lost $200,000. And so the question to ask yourself is that make a big enough difference because of the sacrifice on the upside that I'm giving up? And it may, right? That's a lot of money. I'm not trying to discount that. But a lot of, well, my experience dealing, it's still a big loss. So it still hurts pretty bad. And just understanding what your, portfolio is really doing for if it's doing what you want it to do. So the contrast to that would be 100% bond portfolio in that example would probably be positive, like, right? You would have made money in that portfolio at that time. A 50-50, right, would have cut your loss, in half or probably even less than half because half your money would have hopefully earned money there. So it's what's right for you, the individual, to cushion against that, that downside. I have a question which perfectly ties in. And yeah, feel free to ask questions, at any time. Is my portfolio is 80% equities and 20% bonds. My current plan is to retire in 15 years. Is this allocation appropriate? And that's a great question. I feel like I really just, just addressed that more or less. But the answer to that is one, it's got to be, understanding what that means, right? So that's a fine allocation, depends on how much money you have and how much you're going to plan to live on in the future, right? If I've got $10 million today and I'm only going to live on $100,000 a year, now I don't know many of those people, then the truth about it is you could be invested however you want, because no matter what happens with the markets, you're not going to be spending enough that you really have any risk of running out of money. But if you're, need your money and you want your money to keep pace with inflation, the more equity, the more stock percentage that you have in your portfolio gives yourself a better chance of your money keeping up with that inflation, and won't decrease your purchasing power. So it's impossible for me to say yes or no. I would say it's very specific to you in the entirety of your wealth. Just because I hate when people dance around the questions, so I want to be more direct. I don't see anything wrong with it just per se, right? Because we've got 15 years before you're going to start taking that money. We've never had any 15-year period in a globally diversified portfolio that owns 100% of the pie ever have a negative return. So I'm not uncomfortable with that. It's just making sure that that's what's right for you. Another question just came in is, how do you determine the best percentage for spreading your money across different investments? And that's a great question. It's very similar to the previous answer. It really is what's right for you and how much risk you're willing to take. To me, the first question you ask yourself is stocks to bonds, right? There's only really one way to assuredly reduce downside in a down market, right? I'll give you a few examples that are the more recent examples. 2008, the market crashed, everything crashed. Emerging markets crashed, US market crashed, developed markets crashed, value crashed, growth crashed. If you were 100% globally diversified portfolio in 2008, from the top to the bottom was a 50% decline in value. Now, since then, it's recovered beautifully, but that's the kind of risk that that's possible with that. We saw the same in COVID, right? So COVID, the same thing. In February, March of 2020, we saw large declines with everything. There was nowhere to hide, right? It's not like anything really did well outside of a select few stocks. So the first question is, that's the risk with stocks, right? They're going to have wild upsides. So if you want to dampen that, you can't stomach potentially, not that it's going to happen, but just potentially seeing large declines in value, then it's about the right mixing in bonds, because the bonds are really the only assured way that they'll do well during those huge declines, or at least they'll hold you relatively steady. Not necessarily do well, but they will, they won't have anywhere near the downswing that you would see from a 100% stock portfolio. So it's really, that's where we dig in. What is your risk tolerance? What is the downside you're willing to accept? What does it mean by, giving up upside? Because to lowering downside is giving up upside. And are you comfortable? Are you comfortable with that? Another question just came in, and it is, in a previous slide, you mentioned that the U.S. market has been the best performing market globally. What percentage of my portfolio do you recommend be in the U.S. market? Yeah, I mean, these are great questions. So I can tell you what we do, right? If you are a totally passive investor who believes in markets are completely efficient, there's no advantage in X market versus Y market, you would have 60% of your portfolio in the United States stock market, and you would have 40%, throughout the rest of the world, because the US makes up 60% of the stock market. We believe that you should have a higher allocation to the United States because we live in the United States and it's what we experience every day. We also just believe certain economic conditions allow companies to be more profitable in the United States than other parts of the world. So we have an allocation of 70% or greater to the United States stock market. That's how we look at it, right? I mean, now does that mean it's right? If we looked at last year, the best would be 100% of the United States stock market. That's not always true. So we look from the years 2000 to 2010, 100% stock portfolio, 100% United States stock portfolio in the S&P 500, which is what we all, I don't want to speak for everyone, but what most people think of when they ask what the market return, at least on an annual basis, was negative. $1 million invested in 2000 at the end of 2009 was worth 910,000 if you put it in the S&P 500. As to where a globally diversified portfolio, $1 million in 2000 was worth $1.6 million in 2009. So, the answer to that question is, I believe in the United States, right? It's certainly worked out for us and for our clients to have an overweighting there because it's what we see every day and just for other factors. So we have an overweighting, but we don't just exclude the rest of the world because no matter what, it's going to be bad. That's not always the case. And when we look at things mathematically, if you combine the other parts of the world stocks with the United States, what you do is you do not lower your expected return, but you do lower the risk. So your expected result is the same, but the up and down is less, which is what you're always kind of shooting for in in the US, in any investment, right? I want the best result for the least amount of risk. And you can do that scientifically, mathematically when balancing a portfolio. And that's what we do. That is the objective nature that we're bringing into our clients' investments. I don't see any other questions. Feel free. Anybody can jump in here at any time. I want to, in conclusion, just hit on some last points here. Markets are going to do what they're going to do, right? I kind of hit on it before. We saw the best performing market in the fourth quarter was the Egyptian market. I can't tell you that the Egyptian market is going to be the best performer in the next, in this first quarter. In fact, I can almost assuredly, without even looking, believe that it's probably not. But we can, as I just mentioned, combine investments to give you that best result for the least amount of risk, which is what ideally you are trying to do. So markets are going to do what they're going to do. That leads right to what I was just saying, right? What happened before has nothing to do with what's going to happen in the future. If it did, our jobs would be a lot easier, right? There's a reason that in every disclaimer you've ever seen that's involved in investment is past performance is not indicative of future results. Unfortunately, they don't relate that way. Trust me, I wish they did, but it just doesn't. Hopefully, understanding, at least the next point, understanding the makeup of your portfolio. And this is where I can tell you, this is obviously what I do every single day, but I'm comfortable with the results I get because I know how they came and I'm comfortable with the strategy moving forward. And if you as an investor can ever, can get that, I think you'll be a much better investor, right? So if I'm a 50% stocks and 50% bonds, and I see the S&P 500 return, 26% or whatever it did last year exactly, right? I want to know how much of my portfolio is actually exposed to that, which, whatever amount it is, it is. And then what other parts of the market, how did they do? And here's what my return ended up. And am I okay with that strategy, going forward? And if you can get that, you'll put yourself in a great position to be a good investor and start and quit ever thinking about chasing what did well. And then you have a sound strategy that's built on objective, objectivity versus trying to, chase what was the next best thing. And that, goes into the last point, right? Being comfortable with the returns you experience. Once you know where those returns come from, I think you can probably be comfortable with the result that you receive, good and bad. And then you're going to ultimately put yourself in a great spot going forward and have a very successful investment experience. So, with that, I would just like to say, thank you so much. I appreciate everybody's time, and I hope that you have a wonderful rest of your week. Feel free to reach out to me at any time. We're always happy to talk. Have a great day.